Have you ever been told to think long-term when buying a whole life insurance policy? Specifically, when you look at the cash value, it's very low up front, but the reason it is low up front is because you'll have more long-term in exchange. Have you ever been told something like that? This happens a lot with whole life insurance. Here's the thing though. Imagine if you were banking on having more money long-term, but then it didn't actually happen. That'd be like buying a savings bond and you're expecting to have a certain amount of money 10 years down the road, but then it's not there. It's substantially less for some reason that no one can explain to you. How would you feel about that savings bond? If that happened with whole life insurance, how would you feel about it? Probably not that good. The thing is, this happens all the time with whole life insurance sales. Often, consumers are told to think long-term, and this is often expressed by the agent selling the life insurance policy, and in my opinion, it's used to justify a whole life insurance sale that has a low cash value up front and a higher commission. Here's usually what happens. Someone is interested in a whole life insurance policy, and their agent tells them that the dividends on their whole life insurance policy are going to drive the long-term performance of the policy. When you look at a life insurance policy, your money can go toward what is called the base premium or the paid up additions rider. Base premium dollars do not build cash value up front. In the first year, it's often zero. However, the base premium does drive the non-guaranteed dividend on a life insurance illustration, meaning you'll see a higher dividend for a policy that has a higher base premium. Therefore, the logic from an agent is often go with a higher base premium in order to see better long-term performance. Why I emphasize long-term performance is because remember, this does not give you any cash value up front. So you are going to sacrifice your money early on for the potential of having more money long-term. Does that make sense? Here's the thing. I think that this is just a huge sales tactic to drive more revenue based on premium sales, and here's why. Base premium dollars drive agent commission. That's how it works, period. Like there's no arguing that. When we look at the data, what I've always seen is that high base premium policies tend to underdeliver. What that means is that an illustration shows one thing and the actual results end up being less. I see that happen more with policies that have more of your payment going toward the base premium compared to the PUA rider. I've seen that to be consistent, which means you've got less cash value than what you originally looked at and expected on the illustration. And the other big thing to be aware of here is the dividend on a life insurance illustration is not the only driver of the cash value growth. What we want to look at is the total growth on a year-to-year basis in order to see the accurate number. I'll show you exactly how to look at that. What we're going to do is demonstrate what I just mentioned here. One, with illustrations, and then two, with some actual policies that are quite old. All right, so let's take a look at two illustrations first. We're going to look at one company and one product, a MassMutual Whole Life 100 product. He's paying $100,000 per year. His cash value over here, $83,000 and change. This is a policy where he has $10,000 of the $100,000 going toward his base premium. Okay, then we're going to compare this, which is the same product with the same company, where he pays the same $100,000, but look at his cash value. Instead of 83, it's 65. Why it is less is because his base premium is $30,000 instead of $10,000. Higher base premium means less cash value up front. Look at this though. So here's the justification. So many people fall into this trap. By the 10th year, the illustrated dividend here is $21,656. This is with the policy with the higher base premium. If we go back, remember, $21,656, if we go back, to the example with the $10,000 base premium, by the 10th year, your dividend is less than $19,000. So you see a lower dividend with the policy that had a lower base premium. Does that mean you have less money? The bottom line that I would look at would be my cash value column. The dividend column, sometimes I say throw it out the window because it's so confusing to so many people. So let's take a look at these two side by side. Here we go. On the left, you've got the example with a $30,000 premium. On the right, you've got the example with a $10,000 premium. Same product, same company, same out-of-pocket to you. Let's look at the dividend columns that we just looked at. All right, remember the 10th year? With the $30K premium example, the dividend was $21,656. With the $10K base premium, the dividend, $18,894. Common sense would tell me that the policy that has the higher dividend should have more cash value. Not the case though. If we just look at the cash value at this same point in time, you don't have to be very good at math to see which one's a higher number, right? It's the one with the lower dividend. This is the thing here. So same product, one has a higher premium, which gives me a higher dividend. Look at year 20. You're at $55,768 compared to over here. You're at $50,783. So again, higher dividend in the example with the higher premium. But when I look at the actual cash value growth year over year, let's look at this column. Here you go. Actual growth is just showing what the cash value is growing by year over year. This is what drives me nuts. Look at year 2. Your dividend, in this example to the left, is $1,300. If you told me this, I would say, yeah, but I lost $26,000 that year because in year 1, my cash value was $65,606. I gave you $100. If I just stuffed that under my mattress would then be worth $165,606, but it's worth $139. So I lost money. The dividend is just a gross figure that does not account for insurance expenses, anything like that. It's like, no, that's not transparent, in my opinion. So the actual growth is showing what I am actually getting net from the insurance company year over year. When I look at the 5th year, in this black box, we have the dividend, $10,771. The actual growth, $67.21. That's with a 30K base premium example. Over here, black box, dividend, $85.05. Actual growth, $9,300. The actual growth, that's the column that you want to look at. That shows purely what did you get from the insurance company net year over year. When I look at this, all the way down, you can compare it. You're going to see you're growing faster with this option compared to the example to the left. And if you just want to know what the difference is, here you go. Cash value difference. This is showing you how much more you have in cash value with the option to the right compared to the option to the left. Now the argument that follows up with this sometimes is, yeah, but Steve, if dividends go up, that is going to make this look even better, and eventually you should have more money with the policy that has a higher base premium. I think that's complete nonsense, and here's why. The policies that I've seen over the years where I've heard that argument, I was trained underneath that argument too because base premium dollars generate more compensation, is let's look at an actual policy. So here's a policy that was started in 2007. And what we have on the left is the original illustration. So I was still in college at this point in time. I did not sell this policy, but it is a policy that was sold with 100% base premium. All of his money, the $24K, went toward base premium, and he received a super preferred health rating. The dividend rate in 2007 was 6.75%. So the dividend, which is the dividend column on his life insurance illustration, is based on that dividend of 6.75%, which is very close to where dividends are today in 2025. Now, look at what actually happened. and we pulled all of the data year by year on this policy. Dividend rate came up for a few years. Look at that. For this period of time, the first 6 years, it was higher than that original 6.75% dividend rate. But the purple column to the far right, are those numbers higher than what you see to the left? No. They're about the same. They're a little bit lower, actually. Why on earth would they be lower, though, if the dividend rate came up? Because the base premium, policies with high base premiums, I see them under-deliver all the time. This kind of stuff occurs, and it's people's money that you're dealing with here. Like, you can't do this kind of stuff. But it happens all the time. However, the agent compensation is the highest on the base premium, particularly up front. So what agents always run into is they sell a policy based on an illustration. They think their client's going to have a lot of money long term. They get more money up front. They feel like it's a win-win. But then after the first year passes, the policy under-delivers. They look at it. They don't get it. They try to get an answer from the home office. They can't get it. This back and forth occurs between them and the client says, forget it. This thing is just a load of garbage. I don't want it anymore. They cancel it. The agent already earned their commission along with the insurance company. They make the bulk of their money up front. Like, this kind of stuff happens all the time. So the lesson is, make sure we don't have a policy that's set up with a high base premium. Here is a policy that we put in force right around the time that I got married, back in 2015. He pays $150K per year. Should have included the premium column. The base premium, with this example, is just about 10%. It's actually $14,000 and change. We got it a little bit lower than 10%. He's got a small term rider. The rest goes into PUAs. This was his actual cash value back in 2015. His actual break-even point occurred between 3 and 4 years. In 2025, here's what it is actually doing. He's not paying anything. Net growth rate after all expenses and everything is about 5.5%. Major mutual life insurance company, the key is shrink that premium as low as you can. That's what we always see produce the most cash value up front, the most guaranteed cash value, and when I look at the actual results of these policies, I do see more money. So whenever I hear think long term as a reason to try to justify a higher base premium, my big thing is I just need to see the proof first. Because I'll close with this. If you and I flip positions and you sell me a policy and you convince me that if I go with a higher base premium and take less money up front, I'm going to take a big hit, but I firmly believe I'm going to have more long term, and then it doesn't happen, like, how do you think I'm going to feel toward you? The insurance company, the product. I'm going to feel like I got bamboozled or scammed. Like, that's not good. So that's where I have a hard time justifying this, because I haven't seen any proof. Versus the policies with low base premiums, I have seen proof. So I hope this one made sense. If you'd like more information on this, let us know. You can email me, DM me on LinkedIn. If you have a policy that you'd like to check out, we do offer free second opinions where we can definitely let you know what you have. And if it is a good policy, we will definitely let you know that as well. And I will stop there. As always, I hope this helps.